The Property Bulletin by London Property, the home of superprime.
Alternative investment funds are rapidly gaining popularity among retail investors seeking diversity and returns. By 2025, private equity, hedge funds, and real estate funds will be at the forefront of this trend. Real estate funds, known for stability and long-term growth, real estate funds, REITs, and funds of funds, will remain popular among retail investors. These funds provide diversified exposure to commercial and residential properties, generating income through rentals and property appreciation. They offer relatively low risks and more liquidity compared to private equity and hedge funds. Funds of funds. These pooled investments offer retail investors diversification across multiple asset classes, including private equity, hedge funds, and real estate. As these funds become more accessible and transparent, they provide a cost-effective way for smaller investors to achieve professional asset allocation. By 2025, advancements in financial technology, regulatory changes, and more accessible fund structures will lower entry barriers, allowing retail investors to diversify their portfolios and seek higher returns through alternative investments. However, thorough research and consultation with financial advisors are crucial to align investments with individual goals and risk tolerance. According to a survey by the Royal Institution of Chartered Surveyors, tenants will face higher rents and increased competition for fewer rental properties due to Labour's policies impacting landlords. The survey highlights a decrease in available rental properties and rising demand from renters. Changes in the October budget, including increased stamp duty on buy-to-let properties and second homes, are cited as factors in driving landlords out of the market. Many landlords are selling their properties, leading to fewer rental homes and higher rents. Experts predict that the trend will continue, with rents expected to rise by 5% annually over the next 5 years. Soho Estates, the central London property empire established by the late pawn baron Paul Raymond, generated a record rental income last year, but still posed a loss due to the commercial property market downturn. The company, managed by John James and chaired by former Conservative Minister Stephen Norris, saw its revenue climb 9.7% to £40.7 million in the 12 months ending March 2024, up from £37.1 million the previous year. The increase was driven by the opening of Iona Rose House, a 9-storey office building near Tottenham Court Road, right by the tube station. This is now home to tenants like Warner Bros and Skyscanner. Despite this record revenue, Soho Estates reported a pre-tax loss of £39.5 million compared to breaking even the previous year. The loss was primarily down to a £59.7 million drop in the valuation of its property portfolio, which decreased from £1.14 billion in April last year to £1.09 billion by March this year. The decline in commercial property values has been ongoing, influenced by the rising interest rates, which have pushed up the property yields and lowered the headline prices. The company, controlled by Fawn and India Rose James, the granddaughters of Paul Raymond, owns numerous properties across the West End, including Kettner's Restaurant and Hotel, also Soho House Private Members Club. Despite losses, John James emphasises that the markdown in property values was expected and noted that Soho Estates continues to retain a stable tenant base and sees strong demand in the area. The 6 directors of Soho Estates, including John and Fawn James, collectively received £2.7 million last year, with the highest paid director earning £1.04 million, up from £940,000 in 2023. No dividend was proposed for the year. The company's origins trace back to Raymond's purchase of the freehold of the building housing his Raymond's Review Bar strip club in 1960, with profits used to expand the property portfolio during a property price slump in the late 1970s. Generated a record income last year, but still posed a loss due to the commercial property market downturn. Reforming leaseholds is expected to take years rather than months, according to Alice Bradley, the CEO of the Leasehold Advisory Service, LEASE. Despite the passing of the Freehold and Leasehold Reform Act just before the end of the Conservative government earlier this year, no timetable has been established for its implementation. Speaking at the Society of Licensed Conveyancers conference Bradley emphasised that the government is yet to set up timescales and will deliberate extensively on the steps needed to fulfil its election promise to reform the leasehold system before introducing secondary legislation. In May, shortly before losing power, the Conservative government enacted laws banning leaseholds for new houses and extending standard lease terms to 999 years. However, the proposed cap on the ground rent was omitted. When Labour came to power, they vowed not only to implement these reforms, but also to go further, including adopting the Law Commission's recommendations on leasehold enfranchisement. These changes would grant leaseholders greater rights to extend their leases, purchase the freehold, and assume management functions on the right to manage. Labour also aims to address the high ground rents and eliminate the severe threat of forfeiture as compliance measures. Despite these ambitious promises, progress has been minimal, and frustration over the slow pace of the reform is mounting. As of now, it seems that significant delays are likely to persist, pushing the timeline for substantial leasehold reforms further into the future.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.